Hello and welcome to the financial markets update for October 2020. I am Michael Ball, the Managing Director at Weatherstone Capital Management. In terms of the topics that I want to cover in this update, I want to provide a brief update on coronavirus trends over the past few months, where those stand. Then I want to take a look, as we're getting very close to the presidential election, what the historical returns have been for the stock market since 1968, between the time of the election and the end of the year. I want to also spend some time looking at, if there is a Biden presidency, one of his proposals that could have a significant impact on the performance of U.S. stocks relative to foreign stocks. We'll talk a little bit about the increasing concentration of some of the top stocks inside the U.S. stock market and how that looks historically and some of the implications that that may have. And then finally, we will take a look at the growing levels of government debt relative to the economy and some of the impacts that that has historically had on economic growth. We really can't go through an update about 2020 without looking at coronavirus and some of the current levels of infection that we're seeing and where that may track to over the coming months. The current chart takes a look at the current number of daily cases, which is in the blue line, and the black line, the current number of daily fatalities. And we've had an uptick in cases that settled down somewhat, but still running upwards of 40,000 cases per day. Fortunately, the fatalities have continued to generally trend lower, and they did not exceed the prior highs with the uptick that we saw in July and in August. So that's a positive trend, but as we're getting ready to move back into flu season, and as some of the leading candidates for a vaccine have run into some delays, that is going to cause some potential problems with having a good quality vaccine available as early as many people had hoped. So, there's still going to be difficulty in reopening remaining portions of the economy for a while, and that's going to be an overhang for economic growth in the U.S. Turning now to how financial markets react to presidential elections. There's a lot that we hear this time of year talking about, is a Republican president better than a Democratic president, etc. What I really want to focus on is overall, how do markets behave regardless of who becomes president from the time of the election through the end of the year. In taking a look back from 1968 through the 2016 election, that gives us 13 presidential election cycles that we've gone through. 10 of those 13 cases, we had positive returns. Basically, if you had bought the stock market at the close of the market the day before the election, held it through December 31st. We've had a couple of fairly negative cases, 2000 and 2008. Both of those were when we were, moving towards or in a recession and economic data was worsening. Also, I will note that in 2000, that was also the case in which we had the contested election between Bush and Gore that drug on until about the middle of December. Some of the better cases have come as we're coming out of recessions. So generally, regardless of who becomes president, markets tend to get a little bit more positive, just as the uncertainty of waiting to find out who's going to be in there, what their policies are going to be. At least there's a known in terms of what those policies will be and how to adapt and adjust to those. If Joe Biden does end up winning the presidential election, one of the things that we're going to be watching closely is his proposal to raise the corporate income tax rate from the current 21% up to 28%. The projected impact that it would have on corporate earnings in the near term would be a drop of nearly 13%. This may be enough to begin to have a significant shift on preference for investors from U.S. stocks to foreign stocks. One of the reasons that that may be the case is when we look at the valuation for stocks here in the United States. Here's a chart that goes back to 1995 and looks at kind of what the average measure has been, and then where it's been cheap and expensive, with the top bracket being where things are quite expensive. We've moved above that bracket on the top. It's a little bit skewed by the drop in earnings that we have had because of the coronavirus pandemic. But if we look back just before things started to shift around because of that, we were still pushing near the top of those bands and near the highest levels that we've seen since basically the late 1990s. If we contrast that with where foreign stocks are selling on a valuation basis, there's quite a big gap between the two. If we look at the chart on the right, which takes a look at the valuation of stocks in developed economies from around the world relative to where the valuations are for US stocks, this is a chart that goes back to 2000. And as you can see, we're trading at near the widest gap that we have seen in that roughly 20-year period. And so just to take and to move back could be a sizable bit of outperformance upcoming for foreign developed stocks. Also, if we look at stocks in emerging markets, one of the ways that the valuation there is best measured is by using price to book. And so if we're looking at the relative price to book of emerging market companies relative to the S&P 500, also on that same 20-year look back, we're once again near the widest levels that we have seen in upwards of 20 years. So if earnings now drop for US companies, then investors, pension funds, and others from around the world are going to be increasingly likely to look at and say, is it really worth continuing to pay that much of a premium for US stocks relative to foreign stocks? And we may start to see money and asset allocations shift towards some of those foreign markets. One of the reasons that stocks in the US are trading at a premium relative to foreign markets is that many of the leading technology, internet, and social media companies are based here in the United States. And as there's been an increased shift to a digital economy that's only been sped up by what's going on with coronavirus, people are willing to pay higher valuations for those stocks. As such, it's driven up the prices and the market capitalization for those companies. To look at the impact that it's having on major stock indexes like the S&P 500, in the chart shown on the left-hand side here, it looks at what percentage of the total market capitalization, or basically the weight of the index, is in the top 5 stocks and then the top 10 stocks. So if we look at the top 5 stocks, which are Apple, Microsoft, Amazon, Google, and Facebook, currently the weighting of those companies makes up nearly 22.5% of the total index, which is well up from historical norms, which run about 12 to 13%, so nearly double that level, and even significantly higher than it was back in the late 1990s during the internet bubble. If we take a look at the top 10 companies, which when we look at those, we then bring in Berkshire Hathaway, Johnson & Johnson, Procter & Gamble, Visa, and JP Morgan. The top 10 now account for a little over 29% of the total index, which is also higher than it's been any time since backtracking it from 1990. So there is a great deal of consolidation at the top, which has helped so far because as the digital economy has picked up speed, that's helped the US stock market to do well in this environment. However, if something does happen that causes investors to sour on some of these largest companies, so whether it's for regulatory reasons or other things that may come up, then it could weigh on and have more of an outsized impact to weigh down certain of the large stock market indexes. So we watch this closely and realize that we may need to shift potentially to something that's more broad-based or not capitalization weighted to minimize the impact if some of those largest companies begin to fall out of favor. In all of this, one of the most important factors that we're watching is the fact that the economic contraction that we have seen is very deep, and it's going to be a challenge to fully recover from it. To look at the picture that we have here, this takes a look at and kind of based upon the size of the circle shows the size of the economic decline as well as then the length of time that it's taken to recover as it goes up in height. And so just looking at it, this decline that we've experienced really is more than double the decline that we saw during the global financial crisis, and the third largest that we've seen in the past 100 years. And so while there's a number of good policy responses and things going on to help to stabilize and minimize damage and try to get us back on track quickly, the fact remains that it is a deep decline, and to get fully back is going to be a bit of a challenge. And so it's not unusual that we should expect some bumps along the way. One long-term impact from the coronavirus is going to be the sharp increase in the amount of government debt that's outstanding. That's going to be around with us for a long, long time. And so looking at some of the potential implications that that may have on economic growth and things of that nature are going to be important for considering where the economy and where financial markets may be once we start getting 10, 20, 30 years down the road. The chart that we have here on the left-hand side looks at debt relative to the size of the economy. And the brown line is the amount of government debt. And as you can see, over the past 6-7 years, it's actually stayed fairly stable relative to the size of the economy after having taken a big jump after the global financial crisis. Well, we're once again back in one of those time frames where we're starting to see another big jump in deficit spending to try to stimulate the economy and to get things going once again. And so, we've moved up rapidly, and there's not a high likelihood that we're going to see this ratchet down very quickly in the near future. One of the important long-term implications that comes from the increasing levels of debt is that historically it's tended to weigh down on future economic growth. So the chart that we have here takes a look at total government debt, which instead of like the prior chart we just looked at federal debt, this also brings in state and local debt as well. But then in the table down below in the third column over, it takes a look at what growth rates have been once we've adjusted for inflation, and then looking at the different levels. So on the bottom line, when we've had debt less than 75% of the total economy, after inflation, the economy's grown at roughly 3.6% per year. When it's been between 75% and 105%, growth slowed down a little bit, down to 3.2%. When it's been higher than the 105% level, and as it's increased, up close to 180%, and now we're shooting higher than that, we've now seen that the economic growth has slowed down to roughly 1.4% on average. With the new uptick and with now seeing that debt level reach above 200%, it's going to become increasingly difficult to get back to good, higher levels of longer-term sustainable growth, and it may even be more challenging to maintain some of the slower growth that we've seen at around 1.5% or even 2% for the economy. So it's something that, as I mentioned before, it's more of a long-term impact. It doesn't have a short-term impact on things, but kind of like inflation, it has a significant impact when we start looking over decades rather than quarters or just a few years. So in summary, we still have coronavirus causing a lot of concern and potential problems for the economy because we are seeing continued high levels of cases in many places around the world, and we're not seeing a vaccine on the horizon in the short run. As we're moving closer to election day, and as there is that concern of what may happen, history says that even though there's a lot of political drama that goes on, once the dust starts to settle, markets tend to do pretty well in those last few weeks of the year. And so that's quite a positive for us as we look over the remainder of this year. Next, if we're looking at where there's some potential opportunities in all this, foreign stocks have underperformed U.S. stocks for a number of years. And so they've been a bit more neglected because the U.S. stock market has been the place that has generated higher returns overall. If there are going to be greater headwinds from higher levels of taxation for companies, then the spotlight may start to shift back to foreign companies in foreign markets. And so with them being quite a bit cheaper than what we're seeing in the U.S., there's some pretty good opportunities that may be coming up in the coming months and years from that area. And then finally, a longer term consideration is the fact that as we've had to add a lot of government debt to try to minimize the impacts of the coronavirus recession, that's something that we're going to be carrying with us and needing to pay interest on and look to pay down over a number of years. And historically, that has tended to weigh on economic growth. And so for countries that are doing larger amounts of government stimulus and then potentially having to pay that down over the years, that may have a larger impact on those financial markets as compared to countries where they have not needed to utilize as much stimulus and then have to carry a larger amount of government debt in the years and decades going forward. So with that, we hope that you have a good remainder of the year, and we're looking forward to touching base with you and catching you up on things as we move into 2021. Thank you.